Good morning, everybody. Welcome to another daily market report brought to you by Mike Bjork. Today is Thursday, June 27th, or 28th, excuse me. We got the 28th here. Hey, we're approaching the last day of the quarter and midway through the year. So today, starting to get closer there. Tomorrow will be the last trading day for those days. So be prepared for some perhaps volatility, especially heading into next week with the holiday with the 4th of July and all. But today we got the weekly jobless claims that comes out every Thursday. So last week was an important week because it was what they call the sample week, and that's the week's numbers that they use for part of the calculations when they come up with the jobs numbers for the month of June. So obviously we had a turn 18,000, which is very low numbers, which helps coincide with the jobs numbers, which we can probably expect a pretty strong one coming out next Friday. That should be out next Friday for June. So forecast is supposed to be slightly higher at 220. It came in a bit higher at 227, but still a good number here. We're still in a good range here, 27,000 here. Now, last but not least, here's an important one here. It's the GDP. Each quarter we get so as we're finishing up this quarter, that means we get the final revision for the GDP. So as we saw, we had 2.2. And then we forecast supposed to continue at that same range, 2.2%, but it did drop down to 2%. So obviously that sounds a little bit disappointing. This is for Q1, so the beginning of the year. Now a lot of people were kind of projecting, because we had the tax cuts, the expansion, everything, that this would be much better. But again, you got to understand that this was beginning of the year. Things are just starting off. People are just getting hired around that time. So really things weren't really getting into full production mode. The Atlanta Fed basically came out and said that Q2 they're kind of expecting like a 4%, so that's a pretty high spike there. So wait and see how the Atlanta Fed comes out, and or I mean if that comes into fruition. We'll find that out probably late July with their first version of Q2 numbers. So again, the final revision for Q1 is 2%. So stock market's down. It's kind of, they're at they reach a point where it's kind of high. There's a little bit of there's a bit of uncertainty with the tariffs going on with the trade partners and how that might escalate with the various trade partners, and they're just a little bit concerned how this might affect corporations here. Maybe at some point do we have job layoffs due to it? With that GDP in mind, with a little bit lower expected, where are things going to go? So there's a little bit of uncertainty and a little bit of unrest still with this, because again it's kind of, we'll hear some tough talk, and then we'll hear like, okay, we'll kind of let it settle. Especially like yesterday, we're talking about the regulations. They thought it was going to be really restrictive coming from the executive branch with the foreign investment coming to the U.S. But then then it later came out yesterday that the president will allow the CFIUS to take control of that with they'll update the new laws, and then they will use the laws, and they will govern over that. So it won't be coming from the executive. So that kind of ease their concerns of being a little less restrictive as that case. So again, we got a lot of uncertainty, and that's what's kind of driving what will be driving these markets. Now, here's the bond market. We're down about 8 basis points, or about 9 basis points right now. I've been kind of fluctuating between 6 and 9, and after I created this, it was 9 basis points, and then of course after I did the snapshot, it was like 8 basis points. So anyways, we're off this Fibonacci level. It's going to be kind of a double ceiling here. We got the 100-day moving average down here, and we got the Fibonacci number, which is a pretty tough one. So we're kind of in this range between the Fibonacci here and the 25-day moving average. So again, we have to be a little cautious, because next week, as we mentioned, there's going to be less demand for the mortgage-backed securities and yields. So what would that mean? That means with less demand, these will probably start declining again, as we've noticed in January and in March each quarter, because the Fed is trying to unwind their portfolio, trying to unload some of their portfolio and carry less of these assets. Cases there. So again, but the good news, bad news is good news for the mortgage-backed securities, because with all this trade concerns and the stock market taking, they're going to park their money somewhere. A lot of times they'll park it here. But when you saw the Dow down 300 points, this wasn't up very much. So that tells you how the market is for these right now. There's just not a lot of appetite. for the mortgage-backed securities at this time. And then with the trade talk, China is probably going to be holding up on their purchases as well, as they might cut it off entirely. That would also kind of hurt it because that again drives down demand for our mortgage-backed securities, which will only lower the prices and therefore interest rates rise as a result of it. So be careful here, as I've been talking all week. Even though we're in this range, it looks positive. We got underlying layers that are going to be happening here probably starting next week with the Fed buying less of these mortgage-backed securities and yields of these assets. Okay, again, just be careful. Again, if you look at these, it all looks positive, but knowing this other stuff is what's concerning here. And we got the 100-day moving average. We got a lot of room here for the Treasury. We're just up right now. It was hanging at about 2.83 where it left off, but now it's up to about 2.8.4 range right now. So we still got a lot of room here between these, which could help interest rates. But again, it comes down to next week and the Fed's reduction on their purchases. And it's going to be, again, we've noticed in January and March, once they've done those, rates have climbed as a result of those. So when you look at January to June, basically rates have climbed about 0.5%. So again, it could be another 0.25% we could be seeing as well. All right, so that pretty much sums things up. I hope hopefully I didn't bore you guys too much with all those details, but if you guys want to get more information or if you guys want to get more data, just go over to Twitter. You can find me at Twitter at Mike Bjork and get the updates throughout the day there. Otherwise, I'll look forward to see you guys tomorrow. You guys have a great rest of your day. Thanks so much for watching. Bye-bye.